Jambo. In this video, we'll look at non-controlling interests. Non-controlling interests shows the extent to which the net assets controlled by the group are owned by other parties. In the consolidated statement of financial position, it is necessary to distinguish non-controlling interests from those net assets attributable to the group and financed by shareholders' equity. We had mentioned earlier that total assets and liabilities of subsidiary companies are included in the consolidated statement of financial position, even in the case of subsidiaries which are partly owned. A portion or a proportion of net assets of such subsidiaries in fact belongs to investors who are outside the group, who now we refer to as non-controlling interests. IFRS 3 allows two alternatives of calculating non-controlling interests in the group statement of financial position. Non-controlling interest can be valued at 1, its proportionate share of the fair value of the subsidiary's net asset, and B, full value, usually based on market value of the shares held by non-controlling interests. You are required to know both methods, and the question will tell you which of the methods to use if you'll have to have a question. If you are required to use the full or fair value method, then you'll be given the share price or told what the fair value of non-controlling interest is. You'll normally be required to use the fair value method. The following illustration shows non-controlling interest calculated at its proportionate share of subsidiaries' net asset, the first option. Take a minute and go over the question. Now, you notice that we are told the parent owns 75% of the share capital of the subsidiary. That would mean that 25% is owned by the non-controlling interests. You actually don't have to be told this. You can come and look at the shares which were acquired by the subsidiary, in which case there were 30,000, the shares which parent acquired in the subsidiary, and then you look at the shares the subsidiary has, and then you get the proportion. This is 30 over 40, which ideally would give you 75%. The extra interest, which should be 10 over 40, giving us 25%, is non-controlling interest. Now, in preparing the statement of financial position, you'd have to start with the workings. And all of S net assets are consolidated despite the fact that the company is only 75% owned. The amount, which is net asset attributable to non-controlling interest, is calculated as follows. We've got the non-controlling share capital, 25% of shillings 40,000. That should give us 10,000. And non-controlling share of retained earnings, which is 25% of 10,000, 2,500. And the non-controlling interest value, we get a non-controlling interest figure of 12,500. of S company's capital of 40,000 shillings 10,000 is included in the figure for non-controlling interest. This figure, well, 30,000 is cancelled out with P investment. Of course, the subsidiary has got a stake on the retained earnings in the subsidiary. And when we come to preparing our consolidated statement of financial position, we simply add up our items. All right. And the key thing that you need to notice is that the investment in S cancelled out, and we only show the share capital of the parent. The retained earnings, it will be 25. What is owned by the parent? Let me take you a little bit back to the question, which is owned by the parent, plus 75% of the retained earnings of the subsidiary. And that's what is giving us that figure. Non-controlling interest, we had calculated it earlier as 12,500. And we add up all those other items. Take a minute and put down the question, the solution. This now takes us to the end of that section. Please remember to subscribe and to like the video. Thank you.